Welcome back to our channel, Explained, where you discuss one interesting topic a day. In today's video, we'll be discussing how people afforded homes with 20% interest rates in the 1980s. During the 1980s, the United States experienced an economic downturn which led to an increase in interest rates. In 1981, the Federal Reserve raised the prime interest rate to a staggering 20%, which impacted the cost of borrowing for individuals and businesses. During this time, high interest rates and a challenging economic climate led to a significant increase in foreclosures. In 1985 alone, there were approximately 250,000 foreclosures, which was more than double the number of foreclosures in 1980. Many homeowners found themselves unable to make their mortgage payments due to the high interest rates, which led to defaults and foreclosures. As a result, banks and other lenders had to take possession of many homes and sell them to recoup their losses. It's important to note that the number of foreclosures varied depending on the region and the severity of the economic downturn. Some areas were hit harder than others, and some homeowners were able to weather the storm by utilizing strategies like refinancing or modifying their loans. So, how were people able to afford homes with such high interest rates? Let's find out, but before that, let me know in the comments section below if you or your parents were the homeowners in 1980 and what was your strategy. Number 1. Fixed-rate mortgages. During the 1980s, fixed-rate mortgages were an attractive option for home buyers because they offered a sense of stability and predictability. These mortgages locked in the interest rate for the life of the loan, so borrowers knew exactly what their monthly payments would be for the duration of the loan. For example, let's say a home buyer in 1982 took out a fixed-rate mortgage for $100,000 at a 20% interest rate with a 30-year term. Their monthly payment would be $1,318. In 1985, the interest rate had dropped to 12%, but if this borrower had an ARM, their monthly payment could have increased to $1,568. However, with a fixed-rate mortgage, their payment would remain the same. Number 2. Adjustable-rate mortgages. While adjustable-rate mortgages were riskier, they offered lower initial interest rates, making them a more affordable option for some home buyers. With an ARM, the interest rate would adjust periodically based on market conditions. While this could lead to higher payments in the future, it could also lead to lower payments if interest rates decreased. For example, let's say a home buyer in 1982 took out a 5/1 ARM for $100,000 at an initial interest rate of 15%. Their initial monthly payment would be $1,185. In 1985, the interest rate had dropped to 12%, and their monthly payment would decrease to $1,054. However, if interest rates had continued to rise, their payment could have increased beyond what they could afford. Number 3. Down payments. Lenders in the 1980s were wary of economic conditions, which led them to require larger down payments from home buyers. These down payments ensured that borrowers had a stake in the game and were less likely to default on their loans. For example, if a home buyer wanted to purchase a $100,000 home in 1982, they would need to put down at least $20,000, which is 20% of the home's value. This meant that they needed to save up a significant amount of money before they could even think about buying a home. Number 4. Budgeting and sacrifice. Lastly, home buyers in the 1980s had to make sacrifices and prioritize their spending to afford their homes. This could mean cutting back on non-essential expenses like eating out, buying cheaper groceries, or foregoing vacations and other luxuries. For example, a family looking to buy a home in the 1980s may have had to forego a vacation or put off buying a new car to save up for their down payment. They may have also had to adjust their budget to account for higher mortgage payments, which could have meant eating out less or finding other ways to save money. In conclusion, people were able to afford homes with 20% interest rates in the 1980s by utilizing fixed-rate and adjustable-rate mortgages, making larger down payments, and budgeting and making sacrifices. While these strategies required discipline and sacrifice, they allowed many families to achieve the dream of homeownership during a challenging economic period. Thanks for watching. Please don't forget to like, share, and subscribe for more interesting content.